Welcome to Talking New York Real Estate with Vince Rocco. Our show is all about the exciting world of real estate and in particular, how it relates to the luxury New York marketplace. But if you are not planning a real estate transaction in New York, we still have plenty of information you can use no matter where you are. Now, here's our show. Good morning, everyone. As of spring 2025, the mortgage and finance landscape in New York City real estate market remains dynamic, with lenders continuing to adjust offerings in response to interest rate trends and evolving buyer demand. While mortgage rates have moderated slightly from their 2023 peaks, they remain higher than pre-pandemic levels, prompting increased interest in adjustable rate mortgages and buy-down programs to ease initial monthly payments. First-time homebuyer programs, particularly those backed by state and city agencies, continue to provide competitive interest rates and down payment assistance. This is helping to make ownership more accessible in an expensive market. Additionally, jumbo loan products have become more flexible, especially in Manhattan and parts of Brooklyn, where property values routinely exceed conforming loan limits. Lenders are also offering incentives such as reduced closing cost or rate locks to remain competitive in a market where buyers are cautious but motivated. And at the table with me today are David Rodriguez from Loan Depot, Louise Phillips Forbes from Brown Harris Stevens, and Scott Nadler from Cross Country Mortgage. And they join me now to discuss. But first, let me welcome my listeners and viewers from across the United States and all around the globe. I am Vince Rocco, and this is Talking New York Real Estate. So let's go behind the headlines and into real estate, the state of our industry.
Hi, it's Stephen Bailey from Roadway Moving and Storage. Listening to Vince Rocco, you know the right partner makes all the difference. At Roadway, we deliver an experience your clients will love. For specialized services and white glove care, choose Roadway. Want to learn more? Email me at steven@roadwaymoving.com or visit roadwaymoving.com.
Okay, everybody, good morning again. We are back, and today we have a really brilliant show. Why? Because everything is so loud out there today. The news is loud. We're going to talk about that at the end of our conversation here. But everything is so loud. It's not always accurate. Sometimes it is. But we have to learn how to understand it, listen to it, appreciate it, take it in for what it is. I've got three experts here, two mortgage finance bankers, and a top shelf real estate agent here who understands the marketplace and what buyers and what sellers are thinking about today, because, you know, this business is really all about a mindset. It's all about wanting to do something and actually getting it done. We're going to talk about, optimism, because no matter what goes on out there in this marketplace here in New York City, I firmly believe that optimism is what we all need to have. We have to look past the noise. We have to move forward and do our thing. However, the real estate industry in 2025 started with a fair amount of optimism, but after years of unresponsive sales, inflation, high mortgage rates, interest rates, sales slowed down almost to a grinding halt last year. And it pushed home ownership for a lot of people out of the market. Yes, there's always people who are buying, and we'll get into that. But things seem to turn around at the start of this year. But now with all the talks about tariffs, the complete economic uncertainty, most people over the last couple of weeks losing lots and lots and lots of money in their 401ks and their retirement programs, freaking them out. It seems like all of a sudden things are kind of slowing down again because of all the noise. So there's tremendous fear out there from what I can see, from what I can hear. So I want to get a temperature read from the experts here today. And what is the current climate? Scott, let me start with you.
So much for being optimistic, Vince.
Well, we're going to get there, is my point. What is the current climate out there, and what is all this noise that we're hearing in TV all about?
So needless to say, there's a lot of volatility in the market, correct? And clients are feeling it. But if you take a step back and you look at where the market ended in 2024 to where it is at this moment, the market's down 4.3 to 4.4%, right? So there is a lot of noise. There's a lot of chaos. But if you take a step back and we're not prisoners of the moment, and you look at when you're buying real estate, it's a long-term investment, even if you're going to hold on for 5 years or 10 years, right?
Sure,
you're not buying something. Most of our clients are not buying things to flip in 6 months.
Not anymore.
So I think overall with my clients, what I'm seeing is there was one client I spoke to last week who has an accepted offer, and they said they wanted to take the weekend, reevaluate things, and then come back on Monday. Spoke to them yesterday, they're back. Everyone else, that we've talked about it, they've laughed about it, but they kind of want to see where the chips end up falling. So I think by and large, this is, again, Liberation Day was April 2nd. Today is April 15th. It's been 10 trading days since all this happened. A lot of volatility, but on the grand scheme of things, we haven't seen a massive shift that would cause big buyer changes. So I think at this moment in time, our buyers who are actively looking and making offers are still in the game.
Yeah.
So your book of business, has stayed the same, has grown a little bit, reduced a little bit. Where is that? I mean,
It's funny, and David can probably speak to this too. We've experienced so much volatility over the last several years, right?
We're in the 6th year of that.
Every day we wake up, we have no idea where rates are going to be. They could be up a quarter, down a quarter. We have no clue. So it's very hard to advise clients.
Right.
Whenever we get comfortable in our space, you need to kind of check yourself because something's going to happen. So for the last 4 or 5 months leading up to what's been happening, we've been in that mode of things haven't been as volatile as we've been accustomed to. So we could speak to a client and confidently say, here's where rates are, and know that in a week from now when we speak to them, rates are probably going to be right around where we just spoke about. Now we're seeing all that volatility kind of come back a little bit. So again, by and large, we're used to that volatility, and we know things ultimately will end up coming back. But not being so present in the moment as far as what's happening, kind of looking at the bigger picture is what's ultimately
what's
really
needed.
important.
And just to say, and I've said this many times on this program, throughout this last year, interest rates where they are today, and we'll get into that a little more later, but interest rates where they are today are normal. They're not high compared to what history has shown us. We all get stumped because 2.5%, 3%, 3.4% post-COVID was done for a reason, to restart the economy, to get housing back, where it always used to be. That's never going to happen again. So for those people out there waiting for 2.8, 3.2, ain't going to happen, guys. So forget that and understand where we are is where we're going to be. David, round off a little bit what Scott said. And what about tariffs, though? Because tariffs in people's minds are like, okay, so now we're going to start paying more money for goods, including homes, because
Construction, yes.
Correct. Everything.
So the big thing about tariffs that we always have concerns over, and what you feel in the everyday kind of person is if we see that tariffs get implemented fully, that means we're going to see a slowdown potentially in economic activity. And what does that mean in New York, right? Because at the end of the day, the rest of the country is affected much more than kind of our little bubble here.
Yeah.
But at the end of the day, most of our clients are driven by two things: bonuses and their stock price, right? Think about how everyone gets compensated. You either get a bonus or you get restricted stock units.
And look at the stock
Or a
prices
combination.
Or a combination of both. So when I think about what's happening with tariffs, I'm looking at the person that's sitting in their seat saying, am I going to, one, have a job later in the year because economic slowdown, right? Are they just going to shave off the top? Or two, how is this going to affect, what my bonus potential will be in the future or my restricted stocks? Now, the good thing is, as we were leading up to tariffs, a lot of people kind of expected this to happen, a little bit of volatility. So everyone that just got bonuses in December, January, March, or just got their tranches of restricted stock units, the people that were in their stocks, obviously, they probably tried to liquidate prior to the tariff kind of announcement. And people that got their bonuses did not deploy their money into the stock market. So that's why we haven't really felt, kind of like to Scott's point, we haven't really felt too big of a backlash from all of the volatilities because people just had money sitting in cash.
And some of those people have had that money on the sidelines for a long time, mourning the loss that they on the growth that happened in 24 really.
Correct.
And so I would say that I agree with that. But there's still so much money on the sidelines, and those people pivoted to cash.
Yep.
Still, March was 50% of transactions done were cash over $5 million.
I wanted to
in
ask
Manhattan.
you that, so I'm glad you brought that up. So cash deals are still big.
They're still
cash
big.
deals are still happening.
They're still big, and let's talk. We had a conversation this morning about first time buyers.
Yeah.
A lot of those people that I started working with in 2023, at the end of 2023, and they're still looking. They're patiently have their money on the sidelines. Those are first time buyers, and they are all in contract. All of them. Like I have 6 or 7 of them. And they were so thankful that they understood the value of buying when interest rates are still higher
You have opportunities.
because they can refinance later.
Absolutely. Yeah.
And
Good point.
all of those people were co-op buyers, so
Yeah.
it doesn't cost them anything.
Exactly. Closing costs on a
Yeah.
co-op are minimal compared to that of a condo or a single family home. So yes.
if you are waiting for the interest rates to drop, remember the cause and effect of that is prices go up. So this is when the smart investors lean into drama, noise, because it's opportunistic. I just went to contract with my sons just went to contract on their first investment property. And
Real estate mama.
and
Love
by
it.
and just to be clear, it was the noise of the market was helpful in our negotiations.
Good.
Can I just say though, this is a show hosted by an expert that brings experts on. We all combat voices that are out there. You're a parent, you're listening to another show, you're listening to a TikToker that is giving advice on what's happening, and everyone has an opinion. Everyone
Don't
has a
ask about
strong
my internal
opinion.
voices.
Yes, but
And
take
it's-
what you
it's-
need.
It's so up to us and clients to really listen to the
Listen to
experts.
that,
Sure.
please.
Because
and
it's
take
so
what
it's
you
so
need
important.
and leave the rest.
Yeah.
Take what you need and leave the rest because what's right for one person is not right for you.
Absolutely.
And trust your advisor.
Absolutely. Not to mention rents have been going up as well. So
They
a lot
don't
of these
stop.
first-time home buyers.
We're going to get to that. But Weezy, you and I talked before the show about, there's a lot of noise. Turn off the noise. Turn off the TV. And, Scott and David, just kind of verified all that. We've got to listen to the experts who are at the table, who do this every day for a living. We're the consultant. We're the advisor. We know hopefully better than the people out there who are just, typing away and don't really have any kind of background. They just listen to the craziness on TV and they put it out there.
And I would just to say there's a hand in hand with sellers and buyers. Sellers, if you were trying to buy in this market and sell in this market, don't wait for the interest rates to drop because you think you'll get a bump in what you already have built equity in. Take that and then buy at the same time when you have a stronger interest rate or more expensive interest rate so you have better leverage in your negotiations.
Yeah.
I think the hardest thing, if I look at like the first quarter of the year, I went out swinging January, February, saying to all my buyers, listen, right now you can still get concessions. I go, you have about 3 to 6 weeks left.
Yep.
And we saw that. I was like saying by March it would happen. February, whoosh, all my concessions gone. People were then starting to put, there was multiple bids on certain properties. We're starting to see things go over ask. Bloomberg had a phenomenal article that we were up 29% year over year first quarter. And so we can attribute that to like rates kind of eased a little bit,
Up
not a lot.
29% in mortgages written.
No, in sales in
In
Manhattan.
sales in Manhattan.
Right?
And
yeah.
10.7%, over nationally.
Exactly. So like if you
Exactly.
think about that, we were excited because I was like, hey, get concessions. First time home buyers, get your closing costs paid for, get your maintenance paid for, right?
Right.
And they were all going out making these offers, and by March they were like, that's not happening. And then
Sorry, you're a little late.
They were a little late.
Yeah.
All right. So again, Weezy, where is this 29%, in Manhattan or in New York City coming from? What is
Before
making
I-
up that large
Yeah.
percent?
Before I address that, I want to say one thing. I want to say there's a dichotomy happening, or this moment in time where honestly there is a lack of inventory in New York City's market. So that is why you have all those multiple bids, because maybe there's even the junk that's been on for 300 days
Is
that is
appealing all
now
of a sudden.
priced right
Yeah.
is moving. So, I think that people are tired of waiting. I think that people, particularly when you have a market of the volatility, we knew this was going to be a bumpy year. We knew it was going to be a bumpy year, and we knew that Trump had an agenda. It wasn't quite clear exactly what that agenda was going to be,
Still
but
isn't.
it's going to have a cause and effect. So, everybody wants to own, but you don't need to own.
No.
But people want to own. And so of a city of renters, and I say this all the time, we are 68% of a renter city. So there's only
That's phenomenal,
32% available to be bought. And we have a lack of inventory that has started over multiple unintentional consequences that we have to remind our buyers and our sellers that that's a fact. And the 29%, I mean, listen, there's inventory for developers who have been patiently waiting for very difficult times.
they have.
2023 for me at 393 West End Avenue was not a great time. The last quarter of 2024, I think we did 16 3 and 4 bedroom transactions.
Wow.
That's a lot of inventory. And off-market deals are happening now to the tune of almost $16 million, not even on the market.
Yeah.
So stay leaned into this market, and that is where you will find the opportunities.
I can add to that as well. We're seeing clients that were pre-approved 6, 7, 8 months ago that are still in the game. And
2
these are
years
people,
ago?
even 2 years ago.
Yeah.
But these are people who
long dating.
who we spoke to. We went over what their monthly payments are. They went out, looked at properties, made offers, maybe got outbid. Now they're revisiting things, and we're going over their monthly payments again, and they're right around the same. Whereas in 2022 and 2023, every time we spoke to a client, the payment just kept increasing.
Yeah.
7.45%.
Right.
Yeah.
So this is keeping those types of buyers in the game.
Let me ask you, Scott, because everybody out there wants to know, and even though you said before, rates change sometimes a couple of times in a particular day, what is the current rate as of today here in New York City to buy real estate?
Yeah, so everyone's
Residential.
situation is going to be different. You know, co-op, condo, primary home, second home, all that. By and large, though, you're seeing like a standard 30-year fix somewhere in the higher sixes. 6.7, 6.8, somewhere in
Not
that
bad.
range.
Not
But
bad.
why would you advise somebody to do a 30-year fix?
Sometimes you have to. So like,
Correct.
Yeah.
Because, tell me.
So there's a government subsidized entity, Fannie Mae, right? And so a lot of these banks sell their loans to Fannie Mae when the loan's under $806,000. Even the big banks, right? And even if they're going to keep it on their books, they still want it to be Fannie Mae-esque. So they still price it towards a Fannie Mae rate. And now I'm going to get really boring mortgage on you, but mortgages are sold into pools, right? And those pools are sold in theory to institutions like retirement funds, things like that. And so Fannie Mae is traded, and it changes daily, even intraday. And so when we think about like if a loan is under 806, most banks don't want to take the risk and put that on their books or hold it. They might want the option to sell it.
Loan is 806. Got it. Yeah, okay.
Right. And so if you think about any loan under 806,000, they want it to go Fannie Mae. And Fannie Mae, what's popular in trading right now is only the 30-year fixed.
Yeah, so the ARM would make sense if that spread, that differential between a 30-year fix and an ARM is wide, right? So back in whenever it was 2020, 2019, you would see a 1%, sometimes even 1.25% spread.
But now it's like
Now
this.
it's almost nothing. Sometimes we're seeing the
And what
ARM
about
to be higher.
What about the interest only? And why would somebody be a good IO? Because I love commission only. I love IO.
So well, for New York City, I don't.
Of course you do.
Yeah, I
Go
don't
ahead.
love IO for New York City for our co-op buyers. So 70% of our
All
people,
right.
because the
That's fine.
co-ops think of that as exotic, and they're going to slap us in the face, right? Come the refi, we'll do the IO. But a lot of times we'll get co-ops that are like, first off, they're already unhappy that most of their income is bonus. You
I've
know
been
that.
educating those boards.
Correct.
I said, if you are so concerned, then put it
Correct.
at a 20% debt ratio,
Yeah.
meaning instead of 25.
Yeah, yeah. And even that, take the lowest of the last 3 years if you want, right? But interest only, so where I don't like it on co-op, but on the condo side, so like if we have a high net worth individual, they're compensated. Think about it, most high net worth individuals are compensated with either a base of $250,000 or $500,000, and then they get their bonuses of $1 million, $2 million, right, once a year.
I need to talk to Bess.
So what ends up happening is that client, we put them in an interest only loan where you're only paying interest throughout the year. And then the smart thing to do is once a year when you get your bonus, then you pay down the mortgage and the principal that you would have originally. So an interest only makes sense for certain people, and it has to be high net worth individuals. The banks want them to be high net worth, and we also want them to have a plan so that they don't just go 10 years without paying down their principal.
Yes.
Correct. And there are options for everybody. And as we remember in the past with interest only, that's how we got ourselves in big trouble.
Correct.
Way back in 2008, 2009.
Yeah,
Hold on a minute.
sorry,
We
go
got to
ahead.
take a quick break. We're coming right back. So much more to talk about as Talking New York Real Estate is just getting underway on this very busy Tuesday morning. Don't go anywhere.
The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
Okay, we are back. So, Scott, I interrupted you before the break. You wanted to make a comment.
I
on
think just a bigger point, when you have non-mortgage people who are advising buyers on what kind of product to go with, Not you. Like you.
Yeah, I mean, I still.
You're not
I
the
still,
person. No,
I
no.
still say, bottom line, it's up to you.
Yeah. But it's be careful what you wish for, kind of thing. You know, some clients will say, "Oh, my mother, my brother, my attorney told me to go with an interest-only loan," and we're looking at their profile, and they don't qualify for an interest-only loan, right? Or they don't qualify for an ARM, or they want to get a 15-year fix, and the co-op, their DTI is going to be above what the co-op board is ultimately looking for.
However, I do want to say one thing that I believe, and again, I'll shut up on the IO, but
like it. I
But
use
when
it.
I see people that are about to like take off on their careers, and I know that they've they went from making 280,000 to 580 to 950, and they're close to becoming a partner.
That's not me.
Yes, but
But so it's those people that like their debt to income ratio that's like if they qualify for it, this is a question I like them to ask.
yes. So in the real world, you are 100% right. There's mortgage reality, and then there's reality, right? Our world is very, very different. So when we're looking at someone, we're looking, how do we get them from point A to point B? How do we get them from contract to closing?
Yep.
And if that product is going to be a barrier that gets them to the closing, we need to take that into account. Now, all things being equal, you have a perfect client with perfect credit,
Right.
and they're putting down 50%, and they ultimately qualify for it. Great, yeah, we can, we're going to have interest only any product that person wants. But
Okay.
that's not going to fit
That's not
for
the masses.
everyone.
I get it.
And we'll see a lot of IO like when we work with our financial advisor teams, right? And they're like, listen, we don't want the client liquidating all their money or taking this big of a line of credit against their portfolio, which we'll talk about later. But those people like will end up doing half, like you said, 50% mortgage on them and do it interest only because they have a plan with their advisor. So it's a thing that I always say that the mortgage people are the left side of the balance sheet, the liabilities, and you work with an advisor that's the right side that's handling
Yep.
your assets. So
Absolutely.
really that's the bigger picture of what we do.
And that's where they get confused sometimes, correct? The buyer, they don't necessarily know in what direction to go. But let's talk a little bit about some of the assistance programs that may be out there that are different today than maybe they were a year or two ago. Down payment assistance programs for home buyers, first-time home buyers. Do they exist?
They do. They do.
They
And
do.
and what
Absolutely.
are they?
So
For example.
And do we see those in Manhattan? I want to
it's a great question. So if you're looking at FHA, for example, you would need the building to be FHA approved, which a lot of buildings aren't.
No.
So kind of going through that
And they don't want to go through it.
They don't want to go through it, exactly.
So there is Sony May, which we both have access to, which is the State of New York Mortgage Association, where they have down payment assistance programs. They even Achieve the Dream program.
How much
which
is that used, though?
It's
used.
a very
It's
popular program.
used
It
outside
is.
of the city.
Correct.
Yeah.
More.
Yeah, it is. It is. We see it in the city, but you're right. It is
I
more
was gonna
outside
ask
of
you
the
about
city
the
for
Home
sure.
Buyer Dream program.
Yep.
That's from Sony May?
That's a different program,
Oh, okay.
but similar.
Okay.
Give me the elevator pitch. What is it?
Ultimately, you're getting a 0% interest loan to help with the down payment.
That's
I
forgiven.
see. I see.
That is ultimately
it's kind
forgiven.
of what
After 10 years,
it's kind of what NYU and Columbia is doing with their professors. Is that
But here's the hardship. They also have income restrictions, right? So like if you make, I get this all the time. Somebody's like, I want a first-time home buyer down payment assistance program. I'm like, honey, you make $500,000 and you have $1 million in the bank. Like, no offense, but not happening.
not to you.
Yeah.
Yeah.
And so, and here's the harshest thing about,
But that's good. So tell us what the qualification is.
Yeah, so most of the down they call it DPAL, down payment assistance loan, right? For most of the down payment, they're looking at your income, so you have to be under a certain percent of the area median income. A lot of those programs, so like you'll see HPD has an amazing one that there's only a few lenders that have it, but they'll give up to $100,000 for down payment assistance, and everyone's like, "Oh my god!" Right? But then you go look at the income restriction; it's like $86,000.
Right.
And so, how are you going to qualify for
And
that?
who even? Yeah.
And then here's the second part, like, when we look at these buildings, so a lot of the buildings, when we're looking at down payment assistance program, when they find out that that's a second lien, they're like, wait a second, we don't love that. Because again, most of these buildings have restrictions, right? Of how much we can put for down payment, how much we can have for financing. So the down payment assistance, we do it all the time. The State of New York Mortgage Agency is phenomenal. It's a great program. But I joke and I tell our clients this, you are working through the state of New York, okay? And so a lot of the programs,
Very difficult.
I say I look like a DMV employee, granted with snatch skin and everything, great smile, but it is at the end of the day a DMV product, right? And so we're going to work through it, but you cannot push me on timing. And I tell the agents that too. Like, I'm getting this done and it's going to be on their time, not our time.
It is a
And how
flight
do you-
with a lot of turbulence. You're going to land. We're not going to crash, but you're going to feel like you're going to die.
Then
halfway through the flight.
how do you hedge that in the contract for the time
So
value?
this is where we're getting in
That's a
front.
very good question.
So as we've kind of coached on these podcasts a million times, we're actually working with the real estate agent and the attorney at the time of the offer going in. And before that deal sheet even goes out, we're like, you need to negotiate 45-day contingency. Versus right now, the standard's 30
or even 60.
or 60.
or even 60. I was gonna
If
say
we can
maybe
get
even
60, great, but I get pushback on that all the time.
Yeah.
I know.
So we're doing 45-day contingencies, and I'm starting the loan at the draft of the contract. So we're getting started super early.
But wait, sorry. At what point do you not start the loan at the draft of the contract? Because I'd like them to actually have a commitment if I can.
Well, here's the hard part. A lot of clients, because they go to dinner with their friends, and they sit down.
Oh, you should be shopping.
So this is something that Scott and I deal with all the time. They're like, you should be looking online. And they go online, they're like, hey, Acme Bank Online has a 5% rate. And then you actually dive deeper and you're like, oh, they're paying 2 points, right? So here's the hard thing. We have some clients that actually do start the process with us at time of accepted offer. And then you have the ones that we just kind of let go and run around the field a million times. And then when the person picks up the phone that says, hey, you're buying a coupe, and then they come running right back, right? And so, but we have to let them run. I can't force somebody.
Just like I said before, a lot of noise. That in what I call the syndrome, the cousin, the uncle, the sister, the brother, the aunt,
Yeah.
this one. Everybody's got a comment. Everybody's got an opinion. Wrong.
Yeah. What's
Listen to your mortgage broker.
What's embarrassing is when they have like a high net worth friend and that friend deposited like $3 million at a bank and they got like a crazy low rate. Then it's really embarrassing because you're like, again, sorry for the honey drop, but honey, you ain't got $3 million. Like, okay, it's not, you're not getting that rate.
Talk to us a little bit, Scott, about the conforming loan limits in New York City for this year. Any?
Yeah. So anything up to 806 500 is considered a conforming loan.
Right.
Then there's that sweet spot in between 806 500 and little over 1.2 million, which is that high balance space in New York. So in high cost areas like here, those loans also get sold to Fannie Mae and to Freddie Mac. So those rates are typically going to be higher than it would be for a conforming loan. So anything up to 806 is kind of one category, and then 806 to 102.
One category being lower.
Anything up to 806 is going to put you in the best bracket.
And jumbo is
Right.
going to be over.
Over that 1.2
Right.
space.
1.2,
Yeah,
okay.
exactly.
And to confuse you all, over 806, you can also use the jumbo products for certain people. But this is where, like, when I teach our mortgage class, right? So I say there's 5 things to get a mortgage: credit, income, assets, building approval, appraisal, right? So
I didn't know you taught a class.
Oh, I taught a lot. I teach a
You
lot
teach
of
a lot of
classes.
classes.
I'm coming.
You got to do it. It's really fun.
I'm going to bring my whole team.
Please. And so when you're looking at a jumbo loan, so for example, we have a lot of people, the younger generation, they do not like credit cards. And think about it. Like when I went to university, I was like, ooh, I want to get a hat. Get a credit card, right? Like a free, like university.
The first day of college was get a credit card.
Yeah, University of Texas.
That's it.
Boom, here we go, right? And so you see a lot of the younger generation, they only have one credit card. And I'm like, wait a second, a lot of the jumbo banks, if you want a jumbo product, an IO, an ARM, all those things, they make you have 3 things open on credit showing history for 24 months. And most of these younger generation kind of people buying, they don't have that. So Scott and I are forced to put them on a Fannie Mae loan, which only will let you do it with one item on the
But I
credit.
can start to share that cocktail trivia with all my buyers.
Okay, good.
I learned something new
But
today.
now there are jumbo lenders that will underwrite to Fannie Mae.
Correct.
So it's a jumbo loan.
Wow.
Where it's
And I thought I knew a lot.
part of
$6
our-
billion later in sales.
It's
part of our
I'm
job
learning
essentially
so
is playing
much today.
matchmaker,
And
matching up the client with the right program, because there are so many programs out there.
Okay, so let's talk about trends. What is really trending in mortgage programs, more so than not in the first quarter into the second quarter of this year? Anything in particular?
I don't think it's so much a program because, again, the most standard program is a 30-year fixed, and that's because there isn't that big of a spread between an ARM and a fixed right now.
You're
Most
better
people are
off- you're
gravitating
better off
towards just a
with
30-year
that
fixed.
stability. Because
But I think if we look at someone who is borrowing $850,000, they're very close to 806. So there might be a big difference in that interest rate if they put down a little bit more money to borrow 806 as opposed to 850. So we're constantly looking and seeing what are the options here.
Yeah.
Now, you're going to have less money in the bank. So if you're going in front of a co-op board, we'll have to take that into account. So we're kind of looking at that, a 360-degree view of their file and saying what makes the most sense here. What's important for this specific client.
So I have a question because I am always dancing around the boards and you guys in complimenting the buyer. But what's your thought and philosophy around floating money in or having parents add a duplicate statement and a name to their $80,000 account? Is that considered a gift or is that called co-ownership?
Well, that's a good question. It could be either, depending on the situation, I would believe. Go ahead.
Okay, so I have a lot of clients right now that their parents are getting involved one way or the other, right? And so a parent's number one reason why they don't want to send their kid money is for gift tax.
Yep.
So the thing that we teach and we say, even though we can't speak about it, I always say it even on this podcast, I'm not authorized to speak about it, but you're going to look up what is called the estate transfer within a lifetime. How many times have I said that, right? And in theory, instead of getting money after your parents pass, you can actually, which is an exemption up to $8 million if you're single, 11, I think 8 million.
I got to
and
go
then
back
11,
to work.
and 11 if you're married. But a lot of our clients are getting that wealth transfer while their parents are living. So if you're getting $1 million now, you can only get $7 million later, right? And so we're seeing a lot of parents do that. What your question is how early do we do it, or do we do it while we're in the transaction? And so, by adding them to a statement or whatever, most parents do not want to add their kids to a statement. So what we're seeing is they're either transferring the funds as a true gift, as long as the building allows gifting. And the banks, we don't care. Like, we're going to have most of our products, pretty much 90% of the products out there will let the entire down payment be from a gift. Now, big caveat, everything that Scott and I are discussing, we both worked at banks, like true banks, right? And so when I worked at a bank that
You don't want to talk about?
Yeah. So I worked at many large lenders, and most of our competitors out there still do, right? They have one product, one set of guidelines, right? What we have, like, guaranteed, he probably knows 300 different products right now. So we have access to a massive portfolio. Not only do we have products internally with our bank, but we also broker and we do things like that. So everything we're discussing is not normal. I just want to kind of set the scene.
Yeah. And by the way, a lot of buyers think that working with a mortgage broker that's not bank related is going to cost them more money, where in fact it's more choices.
Exactly. Like I always say, so a client would be like, oh, I bank with Chase. Or I shouldn't say that. Sorry. I bank with a bank, right? And I'm like, this isn't 1950s where you're rolling up in a Cadillac and the branch manager is opening the door for you, right? You got $50,000 at Chase. You're a nobody. I hate to say that, right? You're not going to get a massive discount or massive, like, you're going to a call center in Arizona and they're going to call it a coupe, like I said.
Right.
So what you have to do is really kind of, as an agent especially, you have to educate your clients. You need to work, you're building your team. I said this the other day in a meeting with the broker agreements, right? You are now the Devil Wears Prada. You have the list of the list of attorneys. You have the list of brokers. You dictate what your team is. And so when I talk to anybody that comes in through my real estate agents, I'm saying, I'm a referral only banker and you have access to me and the education I'm about to give you because of your agent, right? And so that is what you own, is the list. And then through what we're going to educate and teach them, we're going to pivot them into the right product that makes sense, and also give you back, the agent, the parameters so that you're not wasting your time.
Amen.
I would just add also, it's much easier for someone like David and me to go to a bigger bank than it is for someone to go from a bigger bank to a company like ours, right? Because we have so many different products and programs and guidelines. We have to go through everything. This is why we tell any agent, any buyer, never let someone tell you you can't get financing. Let us tell you that. Because there's so many things out there that people don't know.
Yeah. Amen.
Let me ask you, Louise, because you mentioned before, a co-op. So how are co-ops these days with parental involvement, whether it's giving them the complete down payment, helping them with down payment, or even co-purchasing? I mean, because we all know that every building is different and they've been difficult in the past, not so difficult. Where are we today with parental assistance? Let's just leave it at that. In co-op purchases.
I mean, there are ways of masking it when you have a more conservative board. But, for me, I decided 20 years ago that I was really going to give my free advice and consult boards wherever they would take me to help educate them to elevate the values of their homes.
Well done.
Holistically.
I love it.
And so with that, I have sometimes, and through those relationships and multiple transactions in buildings, I have built a relationship with many managing agents where I'm coming in there with no ego and only, let me clarify. If you're not allowing gifting today, how do you address that? And so for my own personal experience in my own building, when I was buying my first apartment, I literally had my dad put my name on a duplicate statement. And when it came to me, I realized that his name wasn't on it. And I was like, praise the Lord. and I literally had $1,250 after I closed on my apartment. And I had $80,000 with a single name on it. And I asked with my name on it. But there are a lot of ways of managing that. And part of it is being transparent in the beginning. And often my buyers want their parents to hear it from me. So it's being educated to talk to them about that and also having them have conversations with you guys, because there's a lot of ways of approaching it. You just have to be quiet enough to listen. And I had my own client who ultimately we couldn't do the gift for the building. But the goal is that she's taking a mortgage and her dad's been very sick and he's just gone into remission, and it really made him realize that he wants to support her and give her today part of that whatever that's called.
Estate transfer.
Thank you, the transfer. So I think that you have to get into the details to figure out how to advise properly, and that's asking a lot of questions.
Scott, let me ask you, so when a first-time buyer comes to you and says, give me some advice on how I can improve my chances of getting a mortgage. I'm a first-time buyer, I want to buy, but I don't know anything about the mortgage process, nor am I qualified, et cetera. What do you tell them and how do you advise them?
The best advice is to start early. It's never too early to start and have a conversation with someone like David, someone like me. You don't know what you don't know. Yeah. And when we can go through their financial profile and put together a blueprint, here's what you need to do to buy. Here's what's needed for a co-op. Here's what's needed for a condo.
3 credit cards.
Exactly. Putting together a plan. Hey, this is where you are right now. Here's what you're going to need. We'll talk to first-time home buyers sometimes, and they'll say, I'm thinking about starting a business in 6 months from now. That can drastically change your ability to get qualified for a loan. So
and the reserves that you need to keep for that.
Or even having too much credit at the moment.
Correct. So having that conversation early, just like a doctor, right? You can't diagnose a patient unless you know what the symptoms are. We want to know your symptoms. We don't know everything, right? And it's for your own benefit, so we can, again, put together a plan for you. That's the best advice that we can give a first-time home buyer.
I'm laughing because I teach this class that's called "Oh No, You Did Not," and a lot of it is exactly what Scott mentioned. So, it's like number one, don't go buy a car in the middle of the process, right? Or like during COVID, we were like,
or a boat.
We were like, don't buy a Tesla, and that's not political, sorry. But that was in COVID. And so we're like, don't buy a car, don't buy a boat. And the second one, like now we're coming up to summer, all our finance people switch jobs. So we're like, don't go to, if I see one of my clients on Instagram that's in Ibiza, I'm like, I'm like, that person quit their freaking job because they're on sabbatical, right? And I have to call them and be like, you're in Ibiza, what are you doing? And they're like, I switched my jobs. So like, that's why talking early, finding out if you're on the job search, all those things.
Gardener leaving.
Or my favorite is like, oh, my friend is starting a company and I'm putting money in and they're going to give it back in 6 months. I'm like, oh, the board's going to love that, right? And so we plan for all these things. And
or you should. I mean, I've had all of the above. People quitting jobs. Well, I'm just going to take some time off. Oh, I'm changing jobs, or I just bought a car. I mean, I've had it all. Yeah. I want to talk about agents freaking out. Okay. Unbelievable. So well said, both of you.
Oh, no, you did not.
Oh, I love that.
Coming to a class near you.
Oh, no, you did not. I love that, David. All right, we're going to take another quick break. This is Talking New York Real Estate on the More Network. Don't go anywhere. We're coming right back.
This podcast is supported by the More Network, powered by Brown Harris Stevens. Real estate touches every aspect of our lives, from design and architecture to investing and the economy. Now there's a way to get all your real estate information in one place, the More Network. With more than 20 podcast and webcast series, the Mastery of Real Estate Network is powered by Brown Harris Stevens, one of the country's most distinguished brokerages. Discover advice from notable entrepreneurs, compelling topics, and access to top global real estate experts. Subscribe to their YouTube and Apple podcast channels by visiting GetMoreNetwork.com.
Okay, we are back. So, Scott, let me ask, we're going to talk a little bit about the economy now and all of the noise that we mentioned earlier in the program. Economists anticipate that interest rates may stabilize, meaning, they may decline a little bit, throughout 25 or a lot, who knows, contingent on inflation trends and economic growth. These changes could influence borrowing cost and buyer affordability. But this elephant in the room these days is recession and talk and lots of noise about recession. Where or how will, if we get to a recession, how will that affect things?
Let's be optimistic, right? When a recession happens, what happens to real estate prices? Real estate prices tend to stabilize or go up. In every recession we've had, that's happened except for one, which was the housing crisis, because housing caused it.
Well, that's right.
So,
Clearly.
And if the tariff noise wasn't as loud as it is right now, you'd see rates significantly lower because inflation data has been coming in much lower than expectations.
Exactly.
You've seen CPI come in lower, you've seen PPI come in lower, and that's really what the Fed is focusing on because inflation's really going to bring down rates. That's really where what rates follow. The Secretary Treasurer also has talked openly about the 10-year Treasury, about the focus on the 10-year Treasury coming down. There's a misconception out there that when the Fed lowers rates, mortgage rates immediately follow. That's not the case.
Yeah.
There's an indirect relationship between what the Fed is doing and rates. So I think by and large, when it comes to housing, when it comes to rates, we're in a good spot.
And I want to ask a quick question. When somebody says they've already baked in that announcement, what does that mean?
So the bond market is very forward thinking. Mortgages are tied to bonds, right? So any data that comes out, so exactly what Scott mentioned. So if there's an inflation report, the other thing is jobs, right? So we're going to be keeping a very close eye on the jobs data and unemployment. So anytime we get any type of economic report, that immediately gets digested by the entire bond market and the markets move, right? So already, like when we think about the Fed trying to cut rates, right? As of last week, there were crazy swings because they were digesting all this information.
Yes.
We were seeing as little as 3 changes of quarter point to as high as 5 changes. My personal view is like, we'll maybe get in between that. But the Fed, but when we talk about all the, so
3
quarter
say
point.
it again?
So a quarter point every time for 3 moves.
I see. Got it.
Yeah, so 0.25 3 times.
75 basis
yeah,
points.
so
Got it, got it.
70.75 all the way to 5.
Got it,
So
okay.
what ends up happening as the market gives all this information comes out, bond market digests it, and then we start seeing our projections change. So even if the Fed is going to lower rates, the market already predicted it, right? And so that's why leading up to the Fed kind of changing rates, our rates don't really move much. But weeks prior, we're already digesting that. So two things to look at.
That's interesting.
Beyond the tariff stuff, you want to look at inflation data, exactly like Scott mentioned, and then we want to look at the jobs data, right? So if we see that unemployment rate keep ticking up, I would say bad news is good news for mortgages, right? It means the rate's going to get better. And then on the inflation data, remember I talked about my espresso martini index? Like, so if the espresso martini prices go up, that means rates are going up. If espresso martini prices go down, come down. So inflation's very, very important to mortgage rates.
We're in April, so March, I think the jobs report came out, and it was positive, very positive. Jobs up.
But
so do you see
unemployment went up?
But unemployment went up. So how does that balance when you're looking at the overall mortgage picture? I know, $1 million question, but
so so let's go into like finance 1501. Scott started mentioning the 10-year Treasury, what Scott Bessent's trying to do, right? So the Fed has a checkbook, the Treasury has a checkbook of like $600 billion. Prior to COVID, we were at $300 billion. So what he wants to do is actually take some of that $300 billion and buy some treasuries, buy our own treasuries so that there's scarcity in the market, and that'll help improve interest rates. So that's number one.
That's brilliant.
Right? Number two, if we go back to like the previous, so the big thing that happened during the tough years is the Fed was buying mortgage-backed securities. Remember I talked about we have securities. They were buying commercial securities, and they were all commercial-backed securities, and they were also buying treasuries. And so they still own a bunch of this. And whenever those come up and they're done, they have profits. And what they were doing was doing what's called a runoff. They were just like letting it roll off the balance sheet, right? But during the previous years, quantitative easing 1, 2, and 3, they were taking all those profits. And even though the Fed was not really moving their rates, they were taking all the profits from all this stuff they owned reinvesting it and buying more. So there was a fake buyer in the marketplace, even as all that was going on. So now there's talks, even though the Fed may have to do whatever they need to do because the Fed mandate is only to control inflation. That's it. Right.
Yeah.
And so that's what's going to be the focus. But even beyond that inflation, at least we have these tools, or they have these tools, that they're going to be able to manipulate the treasury. I hate to say that word. Sorry. We'll backtrack. They're going to be able to move treasury prices. And most importantly, when we look at what they're going to do with some of the assets that they already own, instead of letting that run off, they may go, and the Fed may also be a buyer of treasuries. And that's also going to help.
And you can look at the Fed as the biggest customer of these treasuries. So when they were out of the game, you saw interest rates start to go up. Now that they're reinvesting that money back in,
and they were out of the
price
game
up and the rates down.
They were out of the game because they were.
We just lost like half our viewers. That was so sorry.
I know.
I went real technical.
This is
It's
so
important information. I didn't know that.
Yeah.
So it's very important.
And I also think all the more reason why how you like when people say, "Should I lock my rate?" I'm like, call Scott.
Yeah.
Call David, because you will have a much better pulse on what's happening in the back.
What I love is
Well,
I
as you
get these
said before, talk to the experts.
Yeah, I get these calls and they're like, what is your rate today? And I'm like, honey, I ain't give the rate today doesn't matter because we at the end of the month we have 2 major reports coming out. We have inflation data, we had consumer price index, but we really need for the actual, the one coming from the Fed. So we have inflation, and then we also have the Bureau of Labor Statistics jobs data coming out at the end of the month. That's where all my clients are going into contract today. Like we missed our window to lock 2 weeks ago, right? Friday, right after the Fed tariffs, we had like 2 hours, 50 minutes window of locking in rates. Right. That Friday was hell. I was like all hands on deck, right? But now at the end of the month, I have everybody going into contract now. I'm like, sit tight.
Be patient.
We have 2 economic data points that are coming out. We want the tariff stuff to kind of quiet down and then go back to the traditional movement of the markets, which is going to be focused on jobs and inflation.
I also love it when someone sends us an article that says, here's what they're saying about rates. And normally that article
is like 18 weeks behind.
Outdated. I mean, the article would be written an hour ago, but the rates that they're publishing in that article are from a week ago.
98% of the mortgage bankers you talk to will not even know what the hell we just talked about. So if you haven't noticed, we study. Like most of our job is studying.
Yeah.
The rest of this is easy. And actually mortgages are boring as hell. It's this stuff.
Let me tell you something. From what I hear, buyers are listening to you guys more than their own, portfolio managers, because that's kind of, whatever it is.
I mean,
they want to know what's happening and where am I going to be? When am I going to be in a good position to make more money on my property? Can I get the best program, the best loan, whatever? But quickly, yay or nay on recession in the future this year? Based on what we know so far.
Yes.
Recession, yay or nay?
I'm on the fence. Some people say we're already in a recession, but I don't
think we are, but I hear that.
Yeah. I think we're going to pull out of it.
Me too.
Okay. Good to know.
Optimism.
I love it.
Optimism.
Well, I like recession because then that's better for us, right? Like, mortgages do better during recessions.
But I think
I think we are due.
But I think that word, again, all the noise out there, all the talk out there about how bad everything really is or not, you hear the word recession and immediately you retreat and say, oh my God, I can't do anything. I can't buy anything, or it doesn't make sense to buy something, or parents are freaking out because they're losing so much money in their portfolios. You can't buy right now. This is not a great time to buy. And if we go into a recession, it's really worse. Mm-hmm. That's what I'm getting at.
Actually, not the fact.
When I think about
it's not the fact, but this is what the noise is all about.
Think about 2016, 2019, when we had these years of economic instability where things weren't booming.
Right.
Think of our clients that bought during those years. Right. And they did so well with their real estate.
Absolutely.
Right. So it's at the end of the day, a financial advisor is going to tell you to diversify. So if you have just money sitting in cash, that's what we're seeing a lot of our first time home buyers do. They have a lot of money in cash. They don't want to deploy it to the markets. Right. So they're putting it into a down payment on real estate that they're also going to live in.
And a user asset is different than a portfolio asset. And that is one of the defining things for people to justify if they're on the fence, to really try to change your lenses.
Let's talk about inventory. We mentioned throughout the program that there's a definite lack of inventory out there. Not enough inventory coming to market. This is what we call the spring market, the start of the spring market right now. And quite frankly, we're kind of dragging our feet with releasing new inventory for not only first time buyers but for all buyers. Weezy, where are we overall in New York City from an inventory perspective? And in your opinion, what is holding sellers back from listing?
I mean, I'm listing 10 pieces of property in the next 7 days. And so that there is first of all, I think people are finally processing the things I've been saying. I've said it 7, 8, 9 times, but look, people have to process what's right for them. So I'm not a pushy person. I'm here for the right deal at the right time for my clients. But the truth of the matter is that they have nothing to lose because my relationship with them, if it's not good today, let's at least try it. Because there are so many buyers that are out of the woodworks that are dedicated and committed to purchase. And
now, we talk about the luxury market, or
I'm talking $600,000 buyers and sellers who want to upgrade. They want to upgrade, whether they're upgrading out of the city, but transferring that asset. And $7 million. I mean, I sold people apartments and looking at 2014, 2012, 2015, and they're now selling. And I've already sold them another piece of property. So they're just trying to figure out and I think the stars are aligned for a lot of opportunity.
And where is the luxury market at the moment? And we all define luxury differently: 4 million and up, 5 million and up, 10 million and up.
March saw 50% higher transactions, 5 million and above. Correct. 50% in new development.
Yeah. Well, we're going to get to new development in a minute, but just in general, resale. 40 to 50%. Okay. I mean, I can speak to my own business. Maybe that's better for me to say because I didn't study stats stuff for the city. It's
you are the stats.
So, who are we talking to here? Really?
No, but I think there's still a tremendous amount of cash that's transacting.
Oh, that's what I was getting at. Yeah.
It's pulled down. I mean, look at places like Palm Beach. They're only up 3% because there is zero inventory.
Yeah, wow.
Yeah.
And houses in
I wouldn't buy
7 years ago, houses that went for 38 million or like 80 million, and people are looking.
Yeah.
And they're not even on the market.
Talk to us about new development, which you're also very big in.
I mean, listen, there was a lot of
for a long time.
They had to give a lot away. I mean, when I did the underwriting of looking at 4-bedroom apartments in 2018 for 393 West End Avenue, we were looking at 7.4, 7.2. We traded at 6.2.
Yeah,
that's a lot of profit. The deal still was a solid, healthy, one of the best-selling development projects, but end of 22 and 23 was a very long year. And it was nothing is more rewarding when you see the last quarter of 2024 to put 16 transactions together. Every one of them but one was at the asking price. Mm-hmm. We found a market and they found confidence.
In your opinion, how many of these new development buyers these days are investors versus people buying for opportunities to live in and to move on and do whatever? Are there a lot of investors these days?
It's coming. I mean, Kuwait,
Russia's back.
Chinese buyers are leaning into us. A lot of Russian and Ukrainians who have been trying to pull their money out, particularly in these governments where it's become more and more difficult. And so if you think about what Modi at India and the Indian wealth, they can only take so much out a year. Right. So whole family members are taking each person. So whether you have 5 siblings, they're all taking similar money straddled so that they can acquire and purchase and reallocate their assets.
With respect to all cash buyers, we have clients that are closing in cash and then taking financing out the day after closing as well.
With great tax opportunity, which why don't we talk about that?
Yeah. That's a good point. Explain that a little bit because some people don't realize that they can do that. I mean, I heard that recently.
It's a technical refinance. You can call it a cash out refinance, but essentially this allows someone to close in cash. Yeah. They own the property and then take the financing out the day after closing.
And there's some tax, there's closing cost, there's some tax benefits to it.
Correct.
How does that fly in co-ops?
I disclose it. So like we have one right now where a client is buying all cash, and I'm putting it in air quotes because I'm talking about what that means. And then they're going to do a loan afterwards. So we're telling the broker, hey, please put this. I don't want to get the mortgage
cover
decline.
letter.
So it's going to say, well, you're going to add here. It's all cash, and we're going through the board process. But here's the mortgage payment, so you can calculate the DTI in 30 days when you come through with the mortgage.
And I do that in a cover letter.
Yeah.
Yeah,
And then
okay.
here's the main thing. So when you hear cash, if you have $5 million in the bank, if you were to liquidate right now for $2.5 million to buy an apartment, it's highly likely you're going to pay capital gains, right? So most of these buyers that are buying cash, they're not actually in cash for $2.5 million. What they're doing is they're going to their financial advisors and they're saying, hey, financial advisor, I have $5 million in the bank. I'm going to take a margin loan, probably not so much last week, but like I'm going to take a line of credit against my portfolio, which sometimes, depending how you're diversified, I've seen some go as high as 65%. But let's just say 50% to be safe. So if I have $5 million, I can do a line of credit of 2.5. And those people those are the ones that are coming to us saying, hey, we're going to buy cash $2.5 million. But afterwards, I want you to come in and give me a loan of 80% of that, right? And then we give them a check at the closing. So they buy cash off their line of credit. They get their line of credit, moves over to their checking account. They buy it with cash. We close, then, or they close. And then 30 days later, we do the mortgage. We give them a check at closing. And then that money goes back to pay off that line of credit. And then when they get their bonus, or whatever, they work through the cycles. Then with their financial advisor, they pay off the rest of the line of credit of 20% later. So that's a very important
one
thing.
question, line of credits today, or what is the interest on those?
They're expensive.
Yeah, 8?
So it depends. So this is, again, it's all customized, right? So if a client has $5 million with a financial advisor and they're willing to cut their fees, they're charging a fee on that. So I've seen them as low as like 6.5 to 7. But if you don't have a lot of money, they're like
cutting
8%.
Fees?
The financial advisor.
Yeah, because the last thing that banker wants, like I work at ABC Bank.
Yeah.
I'm giving a line of credit of $5 million to my client.
Too easy?
Too easy. And my interest rate is 8%. The last thing I want that person going to another bank and saying, hey, they're offering me 5% if I move money over to that bank. So they're competing with each other. So say, I'll undercut the market just so I can keep your $5 million in our bank.
This is the funny thing
I got
about
a phone call to make. I got a phone call to make, boys.
All right, listen, one last question in the few minutes we have left. Scott, you mentioned before the rental market is booming. And I recently put a condo rental on the market, and I lost.
In terms of prices going up, yeah.
Prices going up and activity.
Yeah.
I lost count at 74 visitors in 3 days. Okay, couldn't believe it.
Wow.
In fact, because we had so many visitors, the owner decided to raise the rent
Yeah.
right in the middle of all my showings.
Wow.
We got a deal, and we got probably more deals.
Yeah.
How is that affecting the mortgage industry? Because we know that some buyers are saying, hey, renters are saying, hey, I got to stop doing this. I need to buy a piece of the rock. I want to do whatever. Do you see people paying high prices in rentals that come to you and say, I think it's time for me to buy?
100%.
Because it's going to even out
Absolutely.
with my payment. It's going to be about
Absolutely.
the same.
This always happens, though. At some point, you're going to have a first-time home buyer that's been renting for 8 years,
Right.
and someone's
Or
going to
more.
think, or they have a friend that buys a home, and they think to themselves, I'm throwing away money every single month. The only person that likes the fact that I'm renting is my landlord right now. Let me explore this a little bit more, and let me just have a conversation. Let me see what my payment would be if I buy a home. Let me see how much money I've saved. As we've talked about here, people in New York have great incomes for the most part. If you're living in the city, how much have they saved over the last 5 to 10 years where they're throwing money away every month to rent? Let's explore it. And once they explore and they see exactly what those payments are, then it kind of maybe a light bulb goes off.
I think Weezy said it before, and I'm agreeing with her. I think people are getting to the point where I have to buy. I need to buy. And maybe I'm spending a little too much in rental, as you just said. I make good money, but I'm not saving anything. So
Absolutely.
I need to do that to buy something. And I'm seeing that I want to call it a transition.
Not to mention work from home. You have a lot of people who have a flexible schedule where they spend more time in their home from a day-to-day basis. So, hey, if they can make their home the way that suits them for their work needs, their living needs.
Yeah.
It makes sense.
Those are most of the calls I'm getting is like, I pay $5,000 in a 1-bedroom now, and I'm trying to go to a 2-bedroom and it's $7,500.
Or more.
I think it's time to buy. And then
Yep.
add in the parents, add in the whole, like that's what's happening.
But it's happening.
Just to be clear, I bought my first apartment and, I had 4 nickels and a quarter, and I had a roommate. As a single woman, but it was important to me to own, and I wanted to buy a certain size. The other thing I like to say to my buyers is that, why don't you consider paying your own mortgage? If you're going to have a $5,000 rent, like pay your own mortgage. And yes, you may end up spending $6,000 for your carry, but it's yours.
Yep.
It's yours.
Okay, everybody, our table talk is done. That's all for now. I'm coming right back after these messages with my closing thoughts for this week. Don't go anywhere.
Hi, it's Stephen Bailey from Roadway Moving and Storage. Listening to Vince Rocco, you know the right partner makes all the difference. At Roadway, we deliver an experience your clients will love. For specialized services and white glove care, choose Roadway. Want to learn more? Email me at steven@roadwaymoving.com or visit roadwaymoving.com.
Okay, everybody, we are back with my thoughts for this week. In April of 2025, which is now, the New York City real estate market reflects a dynamic and evolving landscape shaped by shifting economic forces, consumer behavior, and broader national trends. Buyer activity in the residential sector remains cautiously strong with a 10.7% year-over-year uptick in homes entering contract. This level of engagement is particularly impressive given the persistence of elevated mortgage rates, which have settled into a new normal at around 6.5%, or as Scott said earlier, 6.7%. Let's see if this activity continues. While higher borrowing costs have led some potential buyers to delay their plans or negotiate harder on price, others are adapting with creative financing strategies such as mortgage rate buydowns and adjustable rate loans to move forward with purchases. And at the same time, inventory constraints continue to challenge the residential market. But overall, the New York City real estate market in early 25 is cautiously optimistic. Buyers, sellers, investors, and developers are adjusting to the current economic environment with a realistic but forward-looking mindset. Interest rates may hold steady or even ease slightly later in the year, although challenges such as housing affordability, a pending recession, and global economic pressures persist. The New York City's market fundamentals, diverse employment, global appeal, and tight long-term supply continue to support a resilient outlook for residential real estate. This is my town, people. I say it all the time. And that's our broadcast for today. Thanks to my guests for being here on set with me. You can follow me on Facebook, on Threads, Instagram, LinkedIn, Blue Sky, now Substack, or TikTok at Vince Rocco. And Vince Rocco says the world feels loud right now. The noise, the markets, the uncertainty, it's all moving fast. Stay calm and stay classy. And from all of us here at Talking New York Real Estate and the More Network, to all of you all around the world, thanks for spending a part of your day with us. I am grateful, and I will see you next time. Goodbye, everybody.